Hello everyone, let us continue from where we stopped in our previous session. So now we are supposed to prepare the statement of financial position. We are supposed to prepare the statement of financial position. So you write Bartek Ltd statement of financial position as at 31st December 2013. Bartek Ltd statement of financial position as at 31st December 2013. So, as usual, when we are preparing the balance sheet, we start with the non-current assets. And for the sake of published financial statement, we are supposed to have one figure for PPE. We are supposed to have one figure for property, plant, and equipment. In this case, the property, plant, and equipment will include land, building, plant, and equipment. That is the figure that we should bring here for the PPE. So, since we know that in our question we had land, we had buildings, and we had plant and equipment, we shall have the total figure using working number 6. Using working number 6, and the working number 6 is simply what I had previously told you, that we are supposed to prepare the fixed asset movement schedule. Fixed assets movement schedule is our working number 6. Is our working number 6. So our working number 6. So these are this is the table that you are supposed to prepare for the fixed asset movement schedule. So you have the details. You have land, which is an item in our balance sheet, buildings, plant and equipment, and then you have total. So from our details, we have the balance brought down. So the balance brought down is we can see that this is the cost of our fixed assets. So it's the cost of our fixed asset. Land, we have 12,000. Plant and equipment, we have 100 for 40, which is the cost of plant and equipment. But I would like to draw your attention to buildings. Remember, buildings, the cost of the building is not 38,400, but remember how we got this figure. So the figure of 38,400, we got this figure after revaluation of buildings. Remember, I said that building depreciate, and then we calculated this figure to be the revalued amount at the beginning of the year, but before depreciation for the year. That's why we are calling it the cost. Since you can remember when I was telling you that the moment we depreciate an asset, even the depreciation policy changes. And we assume that after evaluation, the asset, you can assume that this is the time we have bought a new asset. And that's why we are saying from today, after evaluation, this building has a useful life of 16 years. So we are assuming that this building has been constructed or has been acquired today. And therefore, we shall take the revalued amount of 38,400 to be the cost of these buildings today. So the figure for plant and equipment, you can see it on our trial balance. So the total figure is giving us 150,840. So that is the balance brought down. Additions for the year. Additions for the year is in case we have acquired another fixed asset in the course of the year. If we have acquired land, you put that figure on the columns of the land. If we have acquired more buildings, you include it. If we have acquired more plant and equipment, you show that. Then you show the total for additions. In this question, we did not acquire additional asset. So revaluation is another details. It's another items in our fixed asset movement schedule. So this is the format. Even if we don't have some figures, I decided to write the whole format, the whole format for the fixed asset movement schedule. So this is the format for a fixed asset movement schedule. In this question, we don't have some items, but this is how it is supposed to be in case you are given a well-detailed question. So we for evaluation, remember how we revalued our land and buildings. You can revisit our previous workings, how we got revaluation of land of 2400. We got the revaluation of buildings of 19200. I believe that one you remember in our working. Still in this question, we have already worked for the revaluation of land and buildings. So plant was not revalued, and therefore the total revaluation amount is giving us 21,600. That is the total for 2400 plus 19200. You get 21,600. So disposal is another item in our format, but in our question we did not dispose any asset. So in case we disposed, we are supposed to deduct from our assets. We deduct, but in this question we did not dispose. The next item the next item is reclassification. So that is also an item in our format, but in this question we did not reclassify. So when you talk of reclassification, sometimes you are told that an item which was classified under plant and equipment, an item which was classified under plant and equipment was now to be classified as a machinery, was now to be classified under machinery. So it simply means that you are moving it from its previous position to another category, another classification. So that is the reclassification. So you're supposed to deduct it from where it was, you put it to where it will now be classified. So after all that, now you have the balance carried down. Balance carried down is the figure that we get after adding all those. You add the balance brought down, additions, revaluations, you less disposals, you less or you add reclassification, you'll get the balance carried down. I hope you have seen that we have not depreciated any item, or we have not included any amount, or in our format we have not factored in depreciation as per that point. So up to that point we have not factored in depreciation. So you have the balance carried down, all those totals, then we go to the to the next category. So when you close those figures, that is 14,400, 57,600, 100,440, a total of 17,2440. Then below that is where now we factor in depreciation. We factor in depreciation after that, after getting the balance cut down. So the first item, or the first item in our details, you have accumulated depreciation, balance brought down. Accumulated depreciation or balance brought down. So this is simply the figure you have on the trial balance representing accumulated depreciation for our fixed assets. So if you can go to our question, our trial balance, you'll get the accumulated depreciation figure. accumulated depreciation figure. So you have accumulated depreciation as at 1st January 2013. Accumulated depreciation as at 1st January 2013. That is accumulated depreciation at the beginning of the year, meaning we have not factored in depreciation for this year. So that is the accumulated depreciation balance brought down. So for the buildings, we have accumulated depreciation of 9,600. Plant and equipment, we have accumulated depreciation of 40 for 40. So these are the figures we are supposed to factor in on our fixed asset movement schedule, accumulated depreciation. So we go back to that. So we go back to that one. So we continue. So balance brought down, we can see that LAD did not depreciate, and therefore we don't have a figure for accumulated depreciation written to LAD. We go to buildings. We have seen that accumulated depreciation was 9,600. Plant and equipment, we have got 40 for 40, and the total accumulated depreciation is 50,040. So depreciation for the year, that one is simply the figure we calculate for depreciation for this year. Depreciation for the year. Also remember, these are the figures we calculated. And those one we calculated as per note number 4. As per note number 4, we calculated depreciation. For our and I would like to remind you how we calculated them. When you are doing working one in our income statement, cost of sales. So we are told that depreciation is classified under cost of sales. So when you are calculating working one, cost of sales, we factored in depreciation. We factored in depreciation for buildings and depreciation for plant and equipment. So you can revisit that. And you see we got 3,600 and 9,000, a total of 12,600. So it's still in our format. We have an item disposals. So I would not like you to confuse the disposal we have below that and what we had above, still in our format for the fixed asset movement schedule. So the figure we have, the item we have for disposal above represent the asset that was disposed in the course of the year. What we have above, between revaluation and reclassification, we have an item of disposals. So that disposal is an asset that was disposed in the course of the year. So in most cases we dispose at cost. So we deduct this figure at cost. But below that, where now we are currently seeing in our fixed asset movement schedule, we are factoring in depreciation, and we have said that we have accumulated depreciation for the year, then disposal. So what disposal is this? This disposal is if you have disposed an asset in above section, that asset might have been depreciated. It might have been depreciated, and it had accumulated depreciation before it was disposed. That accumulated depreciation of the disposed asset is what we factored in under that category of disposals. that categories of disposals. So you can see that we did not dispose an asset, and therefore we did not have accumulated depreciation of disposed assets. That's why we don't have a figure there. Then from there you go to eliminations. So that one is also an item in our format. Elimination. What do we eliminate? So anytime we revalue an asset, we disregard its previous accumulated depreciation. So I would like us to understand that anytime we revalue an asset, we are supposed to disregard and eliminate and forget its accumulated depreciation, its previous accumulated depreciation. So I am driving your attention to an item, an asset called buildings. So remember, buildings had accumulated depreciation of 96 before revaluation. Buildings had accumulated depreciation of 9600 before revaluation. But now we have revalued our buildings at 38,400 on 1st January 2013, meaning we don't care how much it was depreciated. We don't care it. We no longer care for its accumulated depreciation. You're supposed to disregard that one now and start afresh. As at today, the value of the building is 38,400, and it has a useful life of 38. It had a useful life of 16 years. 16 years. That is what we read in our question. So now we want to eliminate its previous accumulated depreciation. So it had accumulated depreciation of 9600 before revaluation, and that is what we are eliminating. So you eliminate 9600, and now we shall have only the depreciation for the year. That is what we shall be left with. It will start accumulating its depreciation from now, this current year, going forward to the next 16 years. So now you'll get the balance cut down. Remember, the balance cut down is for this category of depreciation, meaning we don't have the balance cut down for LAD, since LAD does not depreciate. So the balance cut down for our buildings, you're supposed to add 9600 plus 3600 minus 9600, which we have eliminated, and our balance cut down will be 3600. Then for our plant, we shall have 40,440 plus 9,000. You have 49,440. 49,440. So for the total figure, we shall add 50,040. You add 12,600. You less 9600 to get 53,040. So that balance cut down, you're supposed to take the previous balance cut down for the fixed asset above, the one that we have we have ruled, we have double ruled, that is the balance cut down for land 14,400, buildings 57,600, plant 100,440. We take that figure, we less the balance cut down below there. So we less for the land, we don't have balance cut down, and therefore the balance cut down for the land above there is the figure we are putting as the net book value. So we get the net book value as the balance cut down of our fixed asset at cost, you less the balance cut down of our depreciation, meaning buildings 57,600, you less 3,600, you get 5,400. Should it be 54,000? So 57,600 you less 57,600, you less that 600, I believe that one should be 54,000. 54,000. You get 54,000. So that one, I hope you can correct that. It should be 57,600, you less that 600, you get 54,000. 54,000. So that one is not 5,400 but 54,000. So 100 for 40, you less 49 for 40, you get 5,100. You get 5,100. Get 5,100. 1724 40, you less 53,040, you get 119,400. 119,400. So this fixed asset movement schedule is very important. It's good to understand it because it will even help you in the future. So the figure we get there, the net book value, the total figure of 119,400 is the figure we are looking for. This is the figure we were interested in, and this is the figure we are supposed to take to our PPE balance sheet. Balance sheet and current asset. We take this 119,400 to our statement of financial position. 119,400. You post it there and you write that is working number 6. Working 6. Then we continue. So another non-current asset is equity financial asset investment. Equity financial asset investment. Remember we have that figure. Under our income, not income, but we have that figure in our trial balance. Equity financial asset of 2,400. 2,400 was revalued downward. Downwards, and we have workings. We have workings for revaluation. So equity financial assets, we revalued downward. So the opening balance for equity financial assets was I've got 2,400 was revalued downward by 1,560, and therefore the balance is 18,840 from our calculation. So that is equity financial asset investment. So current assets, as usual, we have inventory. We don't have adjustment for that, so you write inventory. Account receivables, bank balances as usual. So our total assets is 205,680. 205,680. Go to financed by section. We have ordinary share capital, retained earnings. Remember, ordinary share capital, we are taking the figure as per our trial balance. Retained earnings, we have some workings. Since we have a note that was telling us to transfer revaluation reserve to retained earnings. We transfer revaluation reserve to retained earnings. So we need to have working 8. So from our additional information, the last note in our note number 3. Note number 3 is telling us the company will make a transfer from revaluation reserve to retained earnings in respect of the realization of the revaluation reserve, and we are told to ignore tax on revaluation. So we have a transfer. We have a transfer of revaluation reserve to retained earnings. Retained earnings. So we first need to open revaluation reserve account. Revaluation reserve account, and we know that on our trial balance we don't have revaluation, and therefore we don't have the balance brought down. But we know that buildings was revalued upward. Buildings was revalued upward. When you revalue buildings upward, you debit building, you credit revaluation. When you depreciate, when you revalue buildings upward, you debit buildings, you credit revaluation. This is what we did. We got 19,200. So when you revalue land upward, you debit land with the 2,400, you credit revaluation with the 2,400. Remember, our equity financial asset, which was our fixed assets, we revalued it downward. From 2,400 to 18,840, and therefore it was revalued downward by 1,560. So therefore you credit equity financial asset, you debit revaluation reserve of 1,560. The balancing figure of revaluation is 20,040. And how are we told? So we are told that the company will make a transfer. The company will make a transfer of revaluation reserve to retained earnings. So we are transferring everything that is on our revaluation reserve. So instead of writing balance carried down on our revaluation reserve, we should write retained earnings. Retained earnings of 20,040. So the figure that you can see there that we have written as balance carried down should be retained earnings 20,040. Retained earnings 20,040. Remember, it is on the debit side of revaluation reserve. On the debit side of revaluation account, the figure we have for the balance carried down should be transferred to retained earnings. So that one is we debit. You can replace balance carried down with retained earnings. So 20,040 retained earnings, we debit revaluation, we credit retained earnings. So that is the figure we have, 20,040. So that is one entry. So another thing is that retained earnings, we have the balance brought down. That is as per our trial balance. So when you can go to our trial balance, you'll find that the balance brought down is 22,200. That is the retained earnings brought down. So that is 22,200. You add the profit for the year. Retained earnings for the year 6720. Then you add 20,040, and you'll get the balance carried down as 48,960. 48,960. You go back to our balance sheet. So our balance sheet, we have retained earnings of 48,960 as per working number 8. So long-term liabilities, we have 6% loan note. That one is available on our trial balance. Deferred tax. Remember, deferred tax, we have working number 5. Deferred tax, we have working number 5. Deferred tax. We have the balance brought down. This is 1440. Balance brought down This is 1440. That is as per our trial balance. Then there was a figure that we were accounting for the deferred tax. The figure that we were accounting for deferred tax, and we got some amount to take to the P&L. That is 360. 360, we debited our P&L, we credit our deferred tax. Then we have the balance carried down. The balance carried down was the figure we accounted for, 30%. So it was 30% of 6,000. 30% of 6,000, which was requiring we call it deductible temporary differences. Deductible temporary difference is what we have. So remember, deferred tax is covered under IAS number 12. IAS number 12, that is where we cover deferred tax. So accounting for income tax, International Accounting Standard number 12. So that one we may revisit later. Maybe we shall have like 20 minutes to discuss that one, deferred tax, so you should not worry. So in our question we have 6,000 requiring accounting for deferred tax. So I'm telling you that we calculated 6,000 times 30%. 30% is the tax rate. So we got 1,800, and therefore, so the balance brought down is 1440. Balance cut down 1,800. The balancing figure is P&L 360. P&L 360. So that is the figure we took to our income statement. Deferred tax. That's 360. So here we have balance cut down to take to our balance sheet. 1,800 to take to our balance sheet. So that is deferred tax working 5. 1,800. So we go to current liabilities. We have trade payables. That one we have it in our trial balance. Current tax. Remember, current tax is not paid for. We are told that we create a provision for 880 for current tax. So a provision of 8,880 or 8,880,000 provision for the current tax. If it is a provision under the additional information, it means that it is not paid for. And therefore it is a liability. It will be a liability. So that is our first presentation of our published financial statement. So our balance sheet is balancing at 205,680. Balance sheet is balancing at 205,680. So that is the end of our first question. I am still preparing the second question. At least we do about 2 questions. Remember, we said that this is a question that we expect in our exam. It's a question that we expect in our exam, and it's a question that it requires to be careful. It must be there that you may not notice that this question requires to be solved on a published form. So you be careful. We say that one of the characteristics of this question is that the examiner is telling you to prepare the statement of comprehensive income, the statement of financial position, and the statement of changes in equity. This question is not from our normal questions of branch, farming, not from a hire purchase, not from group. It is not a cash flow question. It is not a question of partnership, but it is an independent question. It is an independent question from a quoted company in Nairobi Security Exchange. So as you continue with your revision, we are still praying for you to pass, and continue revising. So I'll come back to you later as soon as I prepare the next question.